All right. So today I'm just going to take you through some of the basics, really fundamentals of accounting. By a show of hands, how many in this room would consider them an accountant? Woohoo! All right. Raise those hands high. Be proud accountants out there. So if I know, right? But if you are a well-trained accountant and you know a lot of these terms, this is going to be a refresher for you, or maybe just repetitive. But for those of you in the room that don't have an accounting background, hopefully this will be something that just kind of lays the groundwork and gives you the foundation for understanding accounting principles and some of the things that are really important for financial reporting at UC Davis, as well as the entire UC system. So we're going to talk a little bit today about fundamental accounting elements and definitions, double entry accounting. Does anyone know what I mean by double entry accounting? Besides Elise and Karen, people in the accounting and financial reporting group? Debits and credits. All right. Matching principles, that's another concept we'll talk about, and that's really making sure everything gets in the right reporting period. At UC Davis, we only close the books once a year at fiscal close time, and we're probably all really grateful for that because it is quite a process, and if we tried to do that more frequently down to the unit level, we'd probably all be very busy all year long just doing that. So. Chart of accounts, I'm not going to spend a ton of time on that today. I'm just going to kind of lay the groundwork so that you understand some of the key things that go on in the chart of accounts and why it's so important. Jim Seibert from our group is going to be talking about that after lunch, and he'll go into a lot more detail. One thing I'll note, and he's going to show a picture, but it's really complex. So we'll just be highlighting some of the key accounting or key elements within the chart string that are really important that you need to be aware of. Fund accounting. All right, we've got a lot of different funds. Sarah and the budget team talked about it already, but those pie charts that show the different sources, that's what I mean when I talk about fund accounting, but I'll talk a little bit more about why we do fund accounting and give you a little more information on that. And then reporting governance for university financials and what really governs how we report our financials and the information to the Office of the President, as well as to the constituents that use our financials. All right, oh, we've got someone. So what do you think of when you hear the word accounting? I'm hoping I don't see boring on there anywhere, at least not the biggest item. All right, money, numbers. All right, no boring, so excited. Tracking, that's a good one. Accountability, oh, perfect. Fun, yes, someone put fun in just so it shows up. CPA, recording, budgeting. Definitely one of the things we want to touch on today is how budgeting and accounting cross and bring it all together. All right, reports, debits, puzzle. Yes, it's kind of a puzzle. That's what I love about accounting. Snooze, oh no. I like the smiley face. Sam, I don't know about that one. All right. Well, this is awesome. I think numbers, accountability, tracking, it all kind of goes along the same lines of what we're trying to communicate today. All right, so the statement of net position. So the statement of net position is also known as the balance sheet. We call it the statement of net position in the GASB world, which I'll talk about a little bit more later, but really it's our balance sheet. We've got assets, we've got liabilities, and the difference between the assets and liabilities is the net position. So assets are cash, investments, inventory, accounts receivable, capital assets and equipment. Some of those are short-term and long-term, which I'll show an example of later. But those make up our assets, and those are things that just provide future benefit into, future benefit. Liabilities, we've got short-term liabilities like accounts payable. Mike, looking at you. Accounts payable, accrued liabilities that we accrue at the end of the year, salaries, wages, benefits, and things that we have to accrue to make sure they get in the right period and they're there for matching purposes. And then long-term liabilities such as debt. So the university does have a lot of debt to fund building of capital projects and things of that nature. And then our equity, which is our net position. And that's really the residual interest of the difference between assets and liabilities. And there's different restrictions within our net position, right? There's unrestricted, which is kind of what's available to use from an unrestricted, kind of self-explanatory. And then we have restricted expendable and restricted non-expendable. Does anyone know what restricted expendable or non-expendable means? Any endowment folks in the room besides Karen? I know our foundation people are here. So basically endowments and gifts, those are usually either restricted or unrestricted. We get gifts that are restricted for a certain purpose. And then if it's unrestricted, I'm sorry, not unrestricted, but restricted expendable, it's more like a funds functioning as an endowment. So say we get a gift from a donor and that's meant for a specific purpose, we might put it in a fund functioning as an endowment. So it's not an endowment, it's for a purpose, but at some point in time, we'll be able to use that, those funds to build a building. So say we get a $10 million goal on a capital project, and over 3 or 4 years, we're gaining and reaching that goal of the 10 million. Well, we're not going to use that money until we get to that 10 million. So it's put aside. It's expendable because it's once we get all that money, that purpose, it can be used for that purpose. So that's kind of the difference between those categories. And then endowments, those are non-expendable. We can expend the income from those, and that's really regulated, but those are really given to us in perpetuity so that they can be, the income from those can be used to, for different purposes, whatever is designated by the donor. But that's what really is meant by non-expendable and expendable. All right, and just to point out that most of the statement and net position or the balance sheet accounts are controlled by the central office. So I think that's where it gets a little confusing what the departments and what the units actually see. You guys see a lot of the income statement accounts or the statement of operation accounts, which are these revenue and expense items that I'll talk about in a little more detail next. But there is always another side to that entry, and most of those are on central accounts. All right, so I think everyone knows what revenues and expenses are, but I'll go into that here a little bit so we can talk about some of the different types. So revenues, external revenues are sales and services made outside of UC Davis. So types of external sales are really our tuition and fees. Medical center, those revenues are all external. Auxiliaries, anything where we're providing a service or we're getting revenue or income from a third party. I do want to point out that there are non-operating revenues. While we may use them for operations, things like state appropriations, gifts, those are all considered non-operating in the realm of GASB reporting, but we do effectively use them to run the university. So we consider them when we look at those sources as part of our operations, but for reporting perspective, they're shown as non-operating, and I'll give you an example of that in a little bit. I just want to point out too that internal sales and services made between units, those are eliminated effectively from a financial reporting perspective. Those actually don't go up to the top line of the university and get reported as revenues. They're revenues and expenses on a unit by unit basis. But effectively, since we're selling and providing services between each other, those technically get eliminated. So they're important to a unit on a unit perspective, but from an overall university perspective, those are not part of our revenues and expenses. And then I just want to point out a little bit about inflows. We may get money that comes in, but it's not technically revenues. Agency accounts. Does anyone know what an agency account is besides Elise? All right, we've got a lot of people. That's great. So agency accounts, for those of you who don't know, those are really funds that we're holding for somebody else. Good examples of agencies are ASUCD, other student groups. They may use our accounting system so that they can report and record some of their revenues and expenses because we already have something set up. So why would they go out and do something separate by themselves? So we allow certain student groups and things of that nature to use our systems, but they're not reported as part of our revenues. While they have a relationship with UC Davis, they're not our revenues or expenses. And then reimbursements. I go through all of these because I think it's really important to understand the differences. If we don't get them classified correctly in the system, then they get reported incorrectly as well. So just understanding that a reimbursement is an inflow, so you may have gone and spent something, and you're getting reimbursed by another party, and those should be classified as reimbursements very specifically because they should eliminate with the expenses that they're reimbursing. All right, expenses. Is it any surprise to anyone in this room that 70% of our expenses are compensation expenses? Probably not. We're very highly human-based organization, right? A lot of people that work here, a lot of benefits related to that salaries and wages, but total compensation expense is about 70%, and that includes the medical center. So it's a huge part of our expenses here at the university. Another type of external expense are purchases that we make from outside entities. So just to talk in a little bit of KFS terms, PVs or TRECs or DVs, those are, we have an invoice relationship, we have a vendor, someone that we're actually paying for a service outside of the university. And then kind of similar to the inflows I talked about, but outflows. I think for capital and equipment purchases, these actually do show up. Maybe not capital so much, but equipment purchases might show up in the individual units income statement, but then our equipment management team knows all the rules with making sure that those get capitalized. But because those are long-term expenses, I'll use that term loosely, but long-term expenditures, I guess I should say, that they have a useful life over more than just 1 year. And so because of that, they get capitalized in a capital account or a statement of net position account on the balance sheet and depreciated over the life of that asset. So they might be an outflow or a cash outlay for the university, but they're not technically a current period expense. And then I'll throw principal debt payments out there. I don't think many or anyone in this room would see these on their units' financial statements. But just to know, when we do have principal, we borrow money to build a building or something of that nature, those liabilities get reported on the statement of net position, and then as we make those payments, they're cash outflows to the university, but then we're really relieving that liability that's on the balance sheet that was used to pay for that building. All right, here's the fun stuff. Okay, just kidding, it's not really fun. But just to kind of put it in perspective, what I have is 4 slides here, just some snapshots of the University of California, not UC Davis. This is University of California consolidated financial statements, 10 campuses, 4 medical centers, very large numbers here. So you'll see I talked a little bit about current assets. So the assets there, you see the cash, the investments, accounts receivable, pledges receivable, inventories. So that makes up all our current assets. So those are current because they turn over a lot quicker than any of the longer term assets. So we do have a large portion of long-term investments. But you can see, let me use my pointer, this $32 billion of capital across the UC system. And that's net of depreciation. So that's a lot. So non-current assets are the $56 billion there, and the total assets are $68 billion across the UC system. So these are pretty big numbers. This is all available on the OP website. And then I'll just point out really quickly, because if you do the math, you won't get there, but there's deferred outflows of resources that act kind of as assets, but they're not technically termed assets. And those are really a function of our pension and post-retirement health liabilities. So I'm not gonna go into too many details because that would get really boring. All right, so this is just the second half of the statement of net position. I mentioned some current liabilities up there, the accounts payable, accrued liabilities, commercial paper. Those are things, short-term borrowings that we're using to build our capital projects. Yes, and then so our long-term liabilities. I mentioned the debt. You can see that. Let's see. Long-term debt, I can't even see. Oh, the $21 billion right there. And then I briefly touched on the pension and post-retiree health. Those are really large liabilities that have recently-ish come on our financial statements as part of GASB pronouncements. And I'm not going to steal Denny's thunder from tomorrow, but he'll talk a little bit more about those. But really, that's the retirement and the health benefits that you get when you retire. Those are liabilities that of the university. And I will point out that Davis is about 10-ish percent, 10, 11% of the total of the university system-wide numbers. So just to point out too, we've got our net position, our non-expendable endowments and gifts, expendable endowments and gifts, and then our unrestricted. Does anyone notice anything strange about that unrestricted balance? It's negative. It's negative. So again, that's a function of recording our pension and post-retiree health. Those put us negative. Doesn't necessarily mean that we're negative, but because of those liabilities, it did put the university from an unrestricted perspective in a negative position. Overall, though, you can see that we're at the $4 billion total positive net position. So hopefully this is interesting to you. Just to walk through the SHRECNA, or SHRECNIP, they changed it to net assets, from net assets to net position not too long ago. But, I should point out, since our foundation people are here, we do have some numbers for the foundation over here in these other columns. The numbers are a lot smaller, but the foundations are all consolidated and reported on a consolidated basis with the OP financial statements in the foundation columns. So Davis Foundation is in there as well. So operating revenues, like I mentioned, student tuition and fees, grants and contracts, one of our very large line items there. Medical center. So our medical center is about half of UC Davis. There's only 4 medical centers, so it doesn't represent half in the total consolidated university system-wide statements, but it is about half for UC Davis. And so we have about $30 billion of operating revenues. And then operating expenses, like I mentioned, salaries and wages, pension, some of those things that are all related to all the people that work here too are included. And then other operating expenses, that's quite a large category. It's kind of our catch-all. But we're operating at a loss, and that again is more a function of how GASB requires that reporting. I mentioned the state appropriations, which we'll see on the next slide. Even though we consider them part of our operations as well as the gifts, they're reported separately. So you can see them there. And then when you come down to this $1.3 billion increase before changes in net position. So overall, on a system-wide basis, we have $1.3 billion of positive net income, if you will. Again, medical centers and campuses are consolidated in here, if that gives you a hint. And then just how the $4 billion here ties. So we've got the changes in net position, the beginning net position balance, and then the $4 billion that makes up the rest that agrees to the statement of net position. So hopefully that was helpful just to kind of give you a high-level understanding of, the financial statements and some of the reasons why we want to get everything reported correctly. All right, here's our debits and credits. Reminder, if you take nothing else away from this session, debits always equal credits. And that's for a transaction. We're going to show, this is what I call a T account here. And a lot of accounting people will know that that's kind of what we use to do our math and kind of figure things out. But usually all the T accounts are done on an account basis, but when you talk about debits and credits equaling, it's on a transactional level, and I'll have some examples of that next. So left sides are debits, right sides are credits. Debits are always positive and credits are always negative. It's pretty simple, but it gets a little bit more complex when you start getting into more complex transactions. So I think one of the things we wanted to point out today, again, most of the statement and net position accounts and the other side of all the entries, you guys may not ever see that double-sided entry, but just know they're out there. I think one of the key things we wanted to recognize, I'll go through my examples here. So salaries and wages, we pay somebody, or they earned those wages, that hits the expense, and then it's a salaries and wages payable until we actually pay them. Purchases, we buy something, it's recorded as a supply expense, and then recorded as accounts payable. And then our accounts payable team cuts checks, writes and pays those invoices, and then it relieves the accounts payable and our cash goes out the door. Revenues, that's where we switch. Now we have credits. When we record revenue, we record a credit, and we record a receivable as our asset. Now, one key thing to point out is, for those of you that do have receivable accounts and do extend credit to customers, by show of hands, does anyone have that in their unit? I know some of the larger units, yeah, for sure. But if you do have that and you're not sure, some of them obviously have that well covered. But if you record the revenue and record the receivable, but never collect the cash, then that's a problem, right? That revenue is eventually going to go away or be offset by a bad debt write-off. So it's very important that if you do extend credit to customers, you know that you're doing it, that you're managing and monitoring your receivable balances to make sure they're collected, so that you don't end up 3 years down the road saying, oh my gosh, we never collected that. I thought we got that revenue, right? You got the revenue, but you didn't realize it. So I think that's just one key point we wanted to get across for those of you that do experience accounts receivable. Now, I will also say it's not necessarily something we advocate. I think some units definitely have to do it. But if you're not getting payment upon delivering a service or selling a product, then you are extending credit and you effectively have receivables. So if that resonates with people and you don't think you have a receivable account, we need to have a chat. All right. So, and then I mentioned already that the cash, when cash is paid or received, it's actually relieving those statement and net position accounts. All right, just to put some examples out there, when you make a sale, I've got the department records, or the revenue gets recorded on a department account. If you have receivables, which everyone should if you're actually extending credit, the debit hits there on the receivables. So you can see that $100 matches on a debit and credit basis. Cash received, so then you receive the $100 from your customer. The cash comes in and you relieve the account receivable. So there's zero in your receivables. Yes, you've got your revenue and our cash. That's exactly where we want to be. Purchases are made, so the expense hits the department account, and then the credit sits over in the accounts payable, the central accounts payable. We cut a check to pay that vendor, relieve that accounts payable, and that cash goes out the door. All right, our next fun and exciting topic, matching principles. So the easiest way to illustrate this, again, I mentioned at fiscal close, the only time of the year that we actually close our books and make everything, the cutoff is June 30, and whatever happened as effectively we delivered a good or service or something happened before June 30 needs to be recorded in that period, whether we've received the invoice or not. An estimate has to be made, or we look after to see if we paid anything to get it in the right period. So same thing with income. And you might all be very familiar with the AV voucher. If you're involved in the fiscal close process, you probably know the AV voucher well. And a lot of this information is on our website, so just keep that in mind. So here are some examples. The first two are going to be talking about accruals. Again, one's accruing expenses, one's accruing revenue. So if the goods or services were received before June 30, so you ordered something, it came in the door by June 30, but you don't have an invoice yet, what do? We need to record an accrual to make sure that that expenditure gets recorded in the proper period. So a lot of times too, it won't be based on the invoice date. The invoice date could be July 15th. But if that received date is before June 30, that's your trigger to know that it needs to be recorded in that period. Same things with if we're making a sale, if we've done a sale and we've actually completed our portion of that activity prior to June 30, we need to accrue that revenue. We haven't just gotten to sending our invoices out. We send them 3 days after the year end. But all that revenue, if we've actually done what we were supposed to do, we should be recording an accrual of revenue. The second is these couple of items are about deferrals. So if you've deposited cash, so this is more like a prepaid. So cash has come in, we haven't actually provided the service or done something to earn that revenue, then we need to defer it to the next period because that's when the expense will take place. So from a matching perspective, the revenue and the expense needs to match in the period in which that activity will take place. And an example of that, say, is summer session for tuition. We, a lot of times, send out the bills in June, we collect, but those classes don't start till after July. So that's something that we need to defer into the next period because we will not earn that revenue until the following fiscal year. So irrespective of when the invoices go out and when the cash gets collected, it needs to go in the next year because we won't earn it. So effectively at year end, if we canceled all our summer sessions, we'd have to pay all that money back. So a deferral is a liability, and if we got money, and we would have to pay it back if we never went through with that. It never happened, but you know. If expenses have been posted as of June 30 for goods that were received, but the event will take place. So say you have an event that you're throwing on campus, you've rented a bunch of tents. You cut some checks but that event doesn't happen until July or August. Those expenses need to be deferred until the next period when that event actually happens, because we won't collect revenue and those expenses won't be matching with the related revenue until the next following fiscal year. Does that make sense? Hopefully those are relevant examples that people would connect with. Okay, chart of accounts. So like I mentioned, Jim's gonna go into this in a lot of detail, but this is why it's really important. That's why we're telling you all this information, is because our chart of accounts is designed to capture things in a way that report to the Office of the President, help the units report and do their internal reporting and analysis, as well as the central team. So we do a lot of reporting and analysis that help the senior leadership team make decisions, and I'll actually be going through that tomorrow in Denny's session. And benchmarking. So if we don't get things in the right buckets, they're gonna compare us to another university that did get it in the right buckets, and we're gonna look different. So it's really important that we understand the transactions that we have in our units and that we're recording them in the right accounts, because if we don't, then some of these things could get thrown off. Now, I will say, we are a very large organization. There's no question about it. So some things get off here and there, probably not the end of the world, but I think for the most part, we should all strive to get things in the right spots so that the information's relevant, comparable, and easy to understand, and really ultimately gets reported to the right spot in the financials. Oh, change is coming. Jim is going to tell you all about our very complex and wonderful chart of accounts. But it's going to change someday. Sorry, Jim. Don't shoot the messenger either. So Common Chart of Accounts is an initiative that is out there by the Office of the President. And it's really to get all of the campuses and medical centers reporting on the same chart of accounts. Every campus and medical center was allowed to do their own setup as long as we translated it to the right way for OP and their reporting purposes. It's very complex, and we have this huge job that translates everything that we do into the right format. And there's a lot of risk for error and a lot of manual stuff that we have to do to make sure it's right. So OP has recognized this and believes that this is the right way to go, and we tend to agree. We've made it very complex for ourselves, and hopefully the new Common Chart of Accounts across all the system will be simplified, better, a good chance for us to do a little bit more control around it, so that things do, make things less manual for everyone that's kind of operating at the department level as well. So I don't have a date for you. I am sorry. They keep telling us 2020. Lots of things are happening in 2020. And when I asked, they said, well, not July 1. It all depends on, they have a consolidation system that they are putting into place. And until they get that into place, this requirement won't come into play. But I assure you that there will be a lot of conversation on this campus about how we structure our chart of accounts and how that change is going to impact pretty much everyone in this room. So stay tuned. We've got a great team that's going to be working on it. All right, a little bit about fund accounting. So fund accounting is really for governmental and not-for-profit entities, and it focuses more on accountability than profitability. So in the financial accounting world, the corporate world, everyone's focused on that bottom line, that profitability. As we heard today, we're not. We're focused on our mission. We're focused on, doing the things that we're given money to do to help the community, to, research things. Some great things going on at UC Davis and as far as research. So it really comes down to understanding what your fund sources are, what the restrictions on those fund sources are, and how they can be spent. Don't get me wrong, that sounds so simple. I know it's confusing, and every little nuance begs a question, right? So really the source, just kind of summarizing the funding structure, is the source is who gave the institution the resources. Like we talked about, is the state or is it the federal government? Is it a student? What's the purpose, what the funds can be used for? What's the function? So these are some key elements I know that we're going to talk about tomorrow, but there's a difference between function and natural classification. A functional expense is really, did we use it for instruction? Did we use it for institutional support or research? So that's a functional type of expenditure. But then we also have, for financial reporting purposes, a natural classification. Was it salaries? Was it benefits? Was it supplies? So those are some of the different things that we have to consider when we're looking at fund accounting. And this is just a summary of the type of funds that we have at UC Davis: contracts and grants, general funds, reserves, self-supporting funds, indirect and opportunity funds, student fee funds, gifts and endowments, agency, and other. That other bucket. That's a lot of good stuff. But yeah, these are just some of the types of funds that we have at Davis, and they all have their own restrictions or lack of restrictions, and they all have their own nuances. So it's just really important to understand the funds you have in your unit, how they can be used, and how they should be reported as well. Next and final slide. All right, not doing too bad on time. So GAAP, has anyone heard the term GAAP? All right, yes. All right, generally accepted accounting principles. So that's what we talked about today: accruals and deferrals, making sure things are in the right period. That's GAAP. Those are accounting rules and standards and procedures that are defined by the professional accounting industry that govern how we record our transactions and report things. Now, GASB is what we report on. Has anyone ever heard of FASB? All right, yes, lots of great accounting knowledge in this room. But FASB and GASB are the two governing bodies. We follow GASB because we're considered a governmental entity. FASB is more for-profit entities, but, and I will be honest, GASB is a little behind FASB. FASB seems to be the front runner because I think that profitability is a little bit more important, but they're ahead of the GASB on a lot of standards that get released. But the GASB is slowly catching up, and Denny will talk to you more about that tomorrow. And then a lot of I can't say this for sure, but a lot of the public universities are using GASB. I can't say that all of them are, but if you look at a private university, it's going to look completely different than how we report our financials, because they get to report on a FASB basis. So just know that there's a difference, and that's what governs. GASB governs how we report and record and disclose information about the university on a financial reporting perspective. And I just want to highlight NACUBO as well as WACUBO. We've talked a little bit about WACUBO earlier today, or at least Lisa did in her welcome message. But the NACUBO is the National Association of Colleges and University Business Officers. And while they're not a governing body per se, they are an extremely good advocate for universities. So the GASB world is meant for governmental entities. We're not necessarily a governmental entity, even though we fall into that category. So what NACUBO does, and they will take GASBs and things that are coming out, and they'll advocate for universities. They'll see how it impacts a university. They'll even ask, I know UC has been involved in a number of responses, like hey, we're going to be implementing this leasing standard. What does that mean for you guys? So I think it's an important thing to note that while GASB's the governing body, NACUBO is kind of an advocate for universities and provides guidance to help us implement our GASB standards, as well as FASB. They cover both, but they're just really focused on universities. And they're just a great resource for industry information and training. So if any of you have been to NACUBO or WACUBO trainings, they're really good. They're really focused on universities, and so it's a really relevant entity that helps us do our work better. So that is all I have for you today. Does anyone have any questions? Anyone brave enough or care enough? Yes. Yes, good point. So she asked if there was a point at which accruals and deferrals were considered material. At fiscal close, we use a $10,000 limit from a unit perspective. So if you have a transaction that is greater than $10,000, we would expect that you are recording an accrual or deferral for it. I know that is a tiny amount, but I would encourage you not to record something for smaller than that. And there is a materiality level at a university level and an OP level, right? We're huge. So materiality is quite high, although we operate our financial reporting at a much lower level than, say, an auditor would look at us from that perspective to make sure that we've got everything recorded properly.
I can bring the microphone to questions if anyone wants more questions.
All right, we have trained accountants now. Yay. All right, I know we have some